Good morning. It's Thursday, the 3rd of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's somewhat smogged out financial capital. The take. Good rains are always good for India's economy. A bad spell of rains does not mean the opposite either, because India's growth is much more insulated from bad monsoons than ever before. But good rains provide the tailwind both in terms of real impact on ground and sentiment. And if you are trying to divine how consumer-facing industries will do, particularly those focused on rural markets, these are useful and positive indicators. So let's run through some of the monsoon stats that are now out since September 30th broadly marked the end of the monsoon season for 2024. First, the big number. India has received about 935 millimeters of rainfall this monsoon, which was much higher than the 820 millimeters recorded last year in the same period. Now, that is even higher than the normal level of rainfall of about 868 millimeters, which translates to the fact that the southwest monsoon for 2024 was 8% above what is known as the long period average. How dispersed was the rainfall? That's another important question. Very. Between 1st June and 30th September 2024, of the 36 subdivisions in India, the measure that's used here, 33 or close to 90% of the country received normal or above normal rainfall so far. 5 states were in the deficient zone, and region-wise, except east and northeast, all other parts of India received higher than normal rainfall. How good were reservoir levels? Another important point. Well, comfortable as of last week at 87% compared to 71% last year, according to Bank of Baroda research. Now, there are some variations within, for example, the northern region being lower compared to the rest of the country at 68% compared to 86% last year. So what this means for agriculture is that kharif crops like rice and maize, which are grown between July to October, have benefited from the strong monsoons. Remember, the government has just lifted all the bans on rice exports because we are clearly now staring at surpluses. As a follow-on effect, rabi crops, which includes wheat and grow from October to April, will benefit from the higher water levels. So agriculture and the rural economy should be on a better footing in coming months. Now, that's of course the good news. And then there is the not so good news or bad news, which is near-term and external. Tensions in the Middle East, which never eased as such, have now ratcheted up after Israel dropped bombs and then launched a ground offensive into Lebanon last week. Remember, in a few days, we will mark the first anniversary of the Hamas attack on Israel on October 7th, 2023. And now Iran has fired missiles. This affects many things, from the likelihood that oil prices might rise further to potentially longer flying times for airlines flying westwards from here and higher fares, which are apparently getting priced in already into winter fares. Even if oil prices don't rise as such because of supply increases and demand slowdowns, and more on that shortly, movement of cargo already facing constraints could be hit further, which means India's merchandise exports could continue to be under pressure. China, which was on the descendant for the last few years, seems to be turning around thanks to a massive dose of stimulus measures. Now, whether these will lift the Chinese economy from the lows to which it had fallen in relative terms is early to say, but there is a change in mood, which also means that investments could flow back into China or start flowing back into China, particularly portfolio investments if last week's surge is anything to go by. And if China's domestic markets looks up, many global companies who've reduced their China manufacturing exposure, for instance, or had refocused their energies elsewhere may have second thoughts, for example, the luxury goods industry. All this means is that India may lose some of the major tailwinds that could have carried the economy and business confidence further, at least for the rest of the financial year. It does appear that the next few months will see companies gaining from the domestic market, but moving into a somewhat state of heightened alert in the international markets. India's key economic drivers now seem to lie somewhere between good monsoons and strained geopolitics. And that brings us to the top stories and themes for the day. The markets are on hold as external pressures build up. Is $50 a barrel oil on the horizon? Yes, going by Saudi Arabia's threats. Two-wheeler sales are up. Will the festive season surprise? And why is India Inc. holding back from investing in expansion?
This is the Core Report with Govindraj Ethiraj.
The markets are just about steady. The Indian stock markets are still holding steady, very broadly put. On Tuesday, the BSE Sensex closed at 84,266, down about 33 points, while the NSE Nifty 50 settled at about 25,796. That's down about 14 points. Remember, Indian markets are now grappling between a shift in interest from foreign investors who are now relooking at China, and more on that shortly, versus, of course, strong domestic flows which continue. Good monsoons will obviously drive parts of the economy higher, including consumer products, but then Valuations are quite high already. The mid and small cap indices are rising now, diverging once again from the large caps, with both the NSE Nifty mid cap and the Nifty small cap rising slightly on Tuesday. At this point, the BSE Sensex has gained over 16% this year, while the Nifty 50 has gained about 18% this year. The Securities and Exchange Board of India moves on derivatives and speculation. The SEBI is finally moving on curtailing speculation and derivatives after its own data revealed that it's mostly young, trigger-happy traders who are losing the most money in this highly volatile and dangerous segment of the stock markets. On Tuesday, it announced 6 key changes to the index derivatives trading framework aimed at curbing excessive speculation amidst growing concerns about the mounting losses incurred by individual traders, according to the Business Standard. Now, these include increasing the contract size from 5 to 15 lakh rupees, raising margin requirements, and mandating the upfront collection of option premiums from buyers. The new rules will also limit weekly expiries to one benchmark per exchange, bring intraday monitoring of position limits, and remove the calendar spread treatment on expiry days. There's a lot of detail in that, but is something that if you are really interested, you can check out online. But will all this work is obviously the big question. We'll have more on that in the next few days. But my sense is it should to some extent. By how much is something that we have to see. Oil prices now under pressure. A missile attack by Iran, also an oil producer, on Israel has pushed up war premiums on oil markets. Brent crude has jumped more than 5% following the attack on Tuesday and rose again on Wednesday to trade above $75 a barrel, meaning that it's added about $5 in 2 days, according to Bloomberg. Israel has vowed to retaliate, though analysts and traders told Bloomberg that the market hasn't fully priced in the risk of a further attack on Iranian oil facilities or the idea that Tehran might try and block the Strait of Hormuz, something it's threatened many times down the years without actually doing so. The Strait of Hormuz is a narrow waterway at the mouth of the Persian Gulf through which all the region's oil must flow through to reach global markets. Bloomberg explains further that its shallow depth makes ship vulnerable to mines and its close proximity to Iran leaves tankers open to attack from missiles or interception by patrol boats, adding that Iran-backed Houthi militants have been carrying out similar measures against commercial ships sailing through the Red Sea. On the other hand, OPEC Plus, or the Organization of Petroleum Exporting Countries, is likely to ramp up more output from December, while countries outside the alliance are also ramping up production. Bloomberg quoted Clearview Energy Partners saying that oil could climb as much as $7 a barrel if the United States and its allies placed economic sanctions on Iran, or by $13 should Israel strike Iranian energy infrastructure. But as you can see, the markets in general or at large are not thinking that this is likely to happen. Is a $50 a barrel oil on the horizon? Sticking with oil because it is getting interesting, Saudi's oil minister has said that prices could drop to as low as $50 per barrel if the so-called cheaters within the Organization of Petroleum Exporting Countries, which is their own allies, don't stick to agreed-upon production limits, according to delegates in that cartel quoted by the Wall Street Journal. The statements were seen as a threat that Saudi Arabia is willing to launch a price war to keep its market share if other countries don't abide by the group's agreements, they said. Key members of an alliance made of the OPEC and its allies are set to discuss whether to ease production curbs in December at a scheduled online gathering on Wednesday, said the Wall Street Journal. Easing production curbs means obviously producing more. On the other hand, geopolitical tensions have been around for months without any real impact on prices, and these declines have been actually frustrating for Saudi officials, said the WSJ. Before we continue, a short break. If you are a small business, here is a useful announcement. Did you know that Google Maps, Google Search, and GPay, among others, can help you reach more customers and much faster? The Core Report invites you to hear top Google leaders tell you how to leverage new features from the Google tech stack. Join us at the Google India Small and Medium Business Summit at the Leela Ambience, Gurgaon on the 4th of October 2024. Do go to the link in the description and register now. And yes, it's free to join. And now, back to the show. Early signs of a stronger festival season. everybody is focused on the festive season, which is obviously kicked off, and whether it can lift spirits for manufacturers, including in the automotive sector. So two-wheeler manufacturers are now reporting double-digit increase in domestic sales in September, even as they prepare for the festive season that lies ahead. Bajaj Auto, Hero MotoCorp, Honda Motorcycle, and TVS all reported increases in sales ranging from 9 to 28%. The 28% is Bajaj Auto, thanks to strong domestic demand and upbeat market sentiment, the Business Standard reported. The first half overall of this financial year, we are halfway through now, has seen a 16% rise in two-wheeler sales compared to the same period in 2023. Most players who saw that high single-digit to double-digit growth are riding on positive sentiments in the rural markets thanks to good monsoons. The question is, how far will this go and how much of those good monsoons will deliver until the end of the year? Well, that and how four-wheelers will do is something that we will be reporting in coming days, so stay tuned. Why is India Inc. holding back? So data just out from the Centre for Monitoring Indian Economy, or CMI, says India's private sector has announced the setting up of factories and other new projects worth 4.1 trillion rupees or 410,000 crore rupees in the 3 months ended September, a 42% rise from the year ago period. Now remember, these are announcements. But if you were to add this to government's announcements of roads, railways and similar projects worth around 1.4 trillion rupees or 140,000 crore rupees, all of this adds up to about 549,000 crores or 5.49 trillion rupees, says the Business Standard. On the other hand, project completions, however, were slightly lower than the previous quarter. The private sector and government together completed about 0.8 trillion. So that's about 80,000 crores worth of projects in the September quarter compared to about 1.9 trillion rupees, that's 190,000 crores in the same period last year. So sectoral data shows, this is CMI again, as the manufacturing is the biggest contributor with new project announcements at about 339,000 crores or 3.39 trillion rupees, that's double of last year. There has also been an increase in the value of services, excluding financial services, as well as construction and real estate projects taken up in the latest quarter. So hold that thought there. However, electricity projects have seen a decline. Now, there are several reasons and sources for this bump up, including equity capital raised in recent months and also government schemes like the PLI or the production-linked initiatives. At the aggregate level, quoting Reserve Bank of India Business Standard says capacity utilization in the manufacturing sector is about 76.8% for the last quarter, from about 74.7% in the previous quarter. Seasonally adjusted capacity utilization is about 74.6. So I think what you could assume or hold from this is, because this pertains to the last quarter of the last financial year, is that capacity utilization in India is at about a little under 75%. Meanwhile, a study by consulting firm PwC of balance sheets of 2,341 listed manufacturing companies in India for the period 2017 to 2023 showed that revenue generated by non-financial companies in the private sector during the 1920, that's 2019 to 20 to 22, was largely used to deleverage and clean up balance sheets, which is of course a good thing. The problem is if it's too much of a good thing because companies are not spending as much as they should. Private sector investment, especially in machinery, equipment, and intellectual property, has lagged in recent years, and this recovery is incomplete, says PwC, pointing to the latest economic survey, which highlights how private sector gross fixed capital formation, or GFCF, in machinery, equipment, and intellectual property products grew by only about 35% between 2020 and 23. Now, here's the contrast. The gross fixed capital formation in dwellings, other buildings, and structures increased by about 105%, or 3 times almost, in the same period. So, put another way, people were buying buildings, houses, and dwellings rather than investing in plant and machinery. I spoke to Raghav Manohar Narsalay, a partner at PwC and lead for research and insights hub at the consulting firm, and the author of this report. And I also began by asking him why India Inc. was holding back.
If we were to really look at India's balance sheets for the last 5 years, the focus has been on financial prudence, on achieving financial prudence. What we did was we analyzed balance sheets of 2,341 listed manufacturing entities in India for a period of about, say, FY19 to FY23. And our analysis showed that the revenues generated by these non-financial private sectors companies during FY20 to 22 were largely used to deleverage and clean balance sheets, during those years as well as during FY23. What's very interesting, right? So this was certainly a bit in the sense that in FY22, there was a massive revenue growth of about 26% for this cohort over FY20. Somebody would have expected this to be financed by debt, but it wasn't. In fact, the debt numbers in FY22 were lower by about 2.46 trillion in comparison to, I would say, about FY20. And this is despite facing, so if I were to look at the horizon of FY19 to FY23, essentially, what's happening is that despite rising costs even in FY23, it is very interesting to see, companies really reining in their debt levels. So the balance sheet strategies were essentially focused on achieving more financial prudence. And I think it was absolutely great of the Indian Inc. to, have done that.
Right. And is there any industry bias here? Are there some industries or sectors which are tilting the scales, so to speak?
That's a very interesting question. That's absolutely interesting. And, so we did this debt to EBITDA analysis, right? The debt to EBITDA ratio analysis for these companies. And while it kind of showed that the leverage had improved across all sectors, major sectors, the notable improvements are, largely in fertilizers, steel, textiles as sectors. Just let me give you one number and that will kind of whet your appetite, which is the debt to EBITDA ratio for, say, a sector like fertilizer came down from 6.33 in FY19 to as low as 1.72 at the end of FY23. And to your question as to, who defied this trend. So auto ancillary was the only industry in our analysis where the debt to EBITDA ratio has gone a little bit upwards. It is still in a very comfortable zone. So for auto ancillary, it went from, say, 1.84 in FY19 to about 2.17 in FY23, but that's still very manageable as compared to what you would see otherwise. So those were some of the sector-based insights in terms of management.
And would that mean that by inference that auto ancillary has been raising more debt to invest in expansion and rather which is capex and therefore by further extension growth as opposed to some of these other industries which are not?
I don't think that would be a correct way to interpret it because if you look at the ratio, it hasn't gone in a proportion where they would, kind of really go in for expansion in massive ways. But I think my, kind of understanding of this industry and certain discussions surely tell me that a lot of this in the case of auto ancillary would have largely happened, to finance growth in the sense that if you are looking at this particular time period, this was also when the EVs were, gearing up in a very big way to be launched. So, changes within those auto ancillary industries to finance, new products, to finance new IP would have possibly resulted in this, ratio going upwards.
Right. And I'm assuming that's a somewhat positive trend. So on the other hand, your study suggests that the broader takeaway is that Indian industry is not investing sufficiently. And then you also warn of the dangers of that.
So Indian industry, kind of has to really now use its balance sheet. So as I said, we clearly showed, kind of that. And this was showed using the analysis of the National Account Statistics data on capital formation, which kind of shows that, the non-financial capital formations to nation's GDP as, at constant prices, of course, was to the tune of, say, 12.05% during FY23 as compared to 12.11 in FY22. In fact, the share of private non-financial corporations, the gross fixed capital formation in FY23 was lower, in fact, lowest during the period of FY20 to 23. So these numbers kind of indicated that there is a lot to be done. And I think the reticence, right, which is coming in within companies to not really go all out and invest, largely comes from, the consumer sentiment, especially in rural markets, which is now, of course, kind of going to look positive with good rains or, a fair bit of good rain monsoon and some employment schemes, kicking off there. In FY23, etc., I mean, there were issues of consumers not really going all out and buying in the market. The growth was slowing down. There were also, very moderate, I would say, increases that were happening in capacity utilization. Put these two things together, if no one is buying or if there is less buying, and on the other hand, if what I'm, kind of manufacturing is staying in my own, yards, then naturally I would be reticent to invest capital to expand capacities. So I think that is what was really hitting companies. Let's hope that, that this actually moves to a better cycle as we move ahead in this fiscal.
Finally, you say that a sustained delay in infusing capital could stoke disenchantment. I'm assuming, do you mean that because there is no fresh capacity creation, let's say in some of the big industries, include you mentioned steel, for example, earlier, though steel is adding capacity, but there are so many industries. Is that because if they don't increase capacity, then the prospect of job creation is not as good and the overall economic growth may not be as strong as one hoped?
Yes, absolutely. I think given that the state has really said you have great balance sheets, I think it's very important for the private sector now to invest in growth. Well, the biggest challenge is if they don't do that, right, is that they are going to, kind of eat into their own competitiveness. So if I'm not going to finance, or if I'm not going to invest in assets that create new IP, that create new products, new innovations, then my competitiveness is at stake. And more importantly, if you really look at this from a perspective of inflation, which is, kind of softening to a large extent, if the private sector does not really start investing and moving the wheels of the economy, then the government continues to not or needs to continue to do that. And if the government needs to continue to do that, then it continues to borrow. And as we all know in economics, you basically, when we start borrowing, even with this fight of, softening inflation, the degrees of freedom for the central bank to reduce the interest rates reduce. So therefore, it's very, very important, for private sector to really lift its expenses or really start investing, stepping up its capex. So I think that is very, very critical. And this enchantment is a real thing. Imagine that, if you're reducing your capex expenditure, then the remunerative jobs that you would be creating with that increased capex expenditure are not going to fructify or materialize on ground. And when this demographic dividend that we all talk about, with so many youth coming into the job market, if those capex expenses or if those capex doesn't kick off, then naturally there's disenchantment which is going to spread because people will look out for jobs and there won't be many. So I think that is something that we really need to be cognizant about. The private sector needs to step up its capex.
Right, Raghav. Thank you so much for joining me.
Thank you once again, Govind, for inviting me. Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.